Hello and welcome to the Northern Miner Podcast. It is a beautiful sunny day here in Vancouver, where I am for the Vancouver Resource Investment Conference and, of course, AME Roundup. It has been very interesting. I've been working for the Northern Miner since 2012, and this is the first time since I started working there that I've actually attended these two, institutions here in the resource industry on the west coast of Canada. And I tell you, the attendance at both of these shows was very impressive. There is definitely interest in metals and mining. Of course, we already know that. One thing is, reading about these things, that governments are concerned. Another is seeing, 8:30 in the morning packed audiences, no chairs left, standing room only. Pretty impressive, I have to say, and a big shout out and thank you to the Vancouver Resource Investment Conference for inviting me to speak. I gave my speech, and it was great to hear the feedback. I felt like I was jumping off a cliff a little bit as I was telling some of my friends over here, because I did have a bit of a different speech. I think it'll be on YouTube at some point soon here. So I'll be happy to post that and let you know about it. Very quickly, it was in two parts, just so you have an idea. I basically talked about the importance of metallurgy in the earliest civilizations, really from the Stone Age, where there was no metallurgy. It was just the rocks that were unrefined, all the way to the Copper Age, the Bronze Age, and the Iron Age, and how materials got more durable, and how the increased durability of these materials, among other things, and the interesting evolution of metallurgy and how this helped early civilizations dominate other civilizations around them. And so that was the first part. And the second part was all about, I called it Anatomy of a Seagull, referring to a BYD seagull, and where I broke down the metals in a BYD seagull according to weight. So starting with steel, and then moving over to aluminum, and then to copper, then graphite, a mineral, and so on. And discussed its function in the vehicle and who owned the processing. And what you learn, as many of us kind of already know, but when you see the numbers, it does turn your head. At least it turned mine. You see how China dominates the processing, in other words, the metallurgy, of every metal that goes into a BYD Seagull, the $9,700 car that I argue was the business story of 2024, turning the auto industry upside down. And actually, we're going to have a few more BYD headlines here, which I'm really enjoying watching because I feel like it's a concrete representation of the supply chain. It is the supply chain in real-world action and the results. And so BYD is basically my case study, so to speak, my gauge on what happens when you own the processing of a metal, which means you basically dominate the market itself. Because people aren't buying unrefined copper, they're buying refined copper. They're not buying bauxite, generally speaking, they're buying aluminum. And on and on. They want steel. They don't necessarily want, iron ore that needs to be processed, right, with whatever other materials. So it's quite interesting. And I was mentioning this last episode, I think a couple of times. China, for example, dominates almost 60% of the steel market. And iron ore is a very large amount of what goes into steel. And it's not like they own all the iron ore. That comes mostly from Australia and Brazil. So one of the morals of the story, as I was discussing last week with the cobalt market, where something like 70 to 75% of the world's cobalt is produced in the Democratic Republic of Congo, but China refines about 75% of the world's cobalt. So China runs the market, not the DRC. So the choke point, right, the bottleneck in the metals supply chain is really the processing. And in a sense, as I discuss in this presentation, it always has been. It's the metallurgy. So I kind of felt like I was jumping off a cliff talking about all this, ancient history, but I was pleased to see that I got a nice response from those that came and talked to me. And big shout out to everybody. People came who listened to the podcast. So that was a heartwarming thing. Both days that I was at the Vancouver Resource Investment Conference, coming up to me afterwards and saying they listen every week. So very nice to hear from you. Thank you for attending. And once again, thank you to the Vancouver Resource Investment Conference for inviting me. So turning to the news, we have some pretty interesting stories as usual. I thought this one was particularly interesting. It's one of these themes that, frankly, I love on this podcast, which is metals pricing and who dominates the metals pricing and what we've been seeing. And we've been following this story really for years, which is this slow-moving shift of the setting of metal prices for most industrial metals over to China. And one imagines, of course, they want to have the final say on the prices or really be the place where metals are priced. So here's an interesting story on the whole metals pricing theme. This is Bloomberg News via mining.com. Canada wants G7 talks on metals pricing to counter China's sway. This is Bloomberg News via mining.com. Canada wants its allies to explore a pricing floor for critical minerals to address what it views as market interference from China, the dominant supplier of metals key to the energy transition. Canada has been thinking about supporting investment through measures such as pricing floors to address alleged market manipulation, the country's Natural Resources Minister Jonathan Wilkinson said Wednesday at an event in Washington. Such measures would factor in an accounting of environmental and labor standards associated with production, he said. And here is a quote, "We in Canada and in the United States are not going to go into a downward spiral on labor standards in order to compete with China," end quote, he said during the event hosted by the Wilson Center. Quote, "But we need to acknowledge that we do have labor standards that do add costs, and so that has to be built into this conversation around pricing," end quote. Wilkinson said he wants to work with a group of 7 nations to make pricing support initiatives a possible quote-unquote centerpiece of discussions when Canada hosts the G7 summit in June. This could be expanded to other nations like Australia, he said, adding that nickel dumping has caused, quote, enormous problems for our Australian friends, end quote. To build mines and secure resources, investors will need, quote, some degree of certainty that the products that they're actually producing are going to have value at the end of it. If China can simply intervene and crater the price, you will never see the development of the critical minerals that we have to, end quote. The Canadian minister says he has had talks with the Biden administration as well as members of the U.S. Senate and Congress, and he hopes to engage with Trump's team. Under Biden, officials had considered using federal funds to support U.S. critical minerals projects, setting a price floor and then paying the difference when market prices fall below it, in limited circumstances, Politico reported in August. So, quite an interesting situation. I mean, it almost sounds like they want to impose a certain degree of price controls and subsidize, really, the metals industry. And my take on this, again, based on the research I was doing for this presentation, is the real solution to the whole challenge that the West faces in regard to competing with China on the metals markets is actually to build out the refineries and the smelters and all of the metals processing in the West. Because, as I put it in the presentation, until the West has comparable metals processing on their side, it will always be fighting with one hand tied behind its back economically against the Chinese. So, in a sense, maybe you have price controls on your metal. Great, you keep them in business. But if you're still going to ship, 50% of your metal or more to China to get refined, are you at all ahead in this whole equation? And I'm not sure you are if they continue to dominate the processing, the metallurgy, so to speak. So it's interesting. And I am getting the sense that there is an increasing awareness of the importance of refining and smelting and metals processing in general. Again, China dominates the markets for most metals, if not all of them. But it's not because they actually own all the metal. They just are the place where it's the best place to get processed. So the UK, for example, rather than trying to be an AI superpower, I don't know why they don't build refiners and smelters and have the best metals processing in the world. Again, what would that do to their economy? To me, it seems like would be the greatest thing they could do. They still have the London Metal Exchange, at least in name, as we're going to learn next story here. It's slowly moving over to Hong Kong, as we've been pointing out, and it's interesting. January 20th, on a very busy news day, we got this story. LME approves warehousing in Hong Kong a gateway for metals to China. And this is Reuters via mining.com. So on the same day as inauguration, the LME announces that they are going to approve warehousing in Hong Kong. So here's the story courtesy of Reuters. The London Metal Exchange on Monday approved Hong Kong as a warehouse delivery point seeking to boost access to mainland China, the world's biggest metals consumer. Approving warehouses in China to store LME-traded metal has been a strategic goal since Hong Kong Exchanges and Clearing bought the LME in 2012. So we've discussed this many times. It only stands to reason if Hong Kong Exchanges and Clearing bought the London Metal Exchange in 2012 that ultimately they want to move it over to China. And now they're doing it. And I can't help but look at that news day. With the least amount of attention, they made that move. So we happily highlight it here at the beginning of the show. Let's continue. The world's largest and oldest industrial metals trading venue, LME, said Hong Kong warehouses will be able to store all 6 of the main metals traded on the exchange. Despite high costs in Hong Kong, there has been significant interest among warehouses, landlords, and metals owners, LME CEO Matthew Chamberlain told the Reuters Global Markets Forum on the sidelines of the World Economic Forum annual meeting in Davos, Switzerland. So this is always the same story. It's always Matthew Chamberlain leaking on the sidelines to Reuters about what's going on here. And, as I say, the symbolic nature of this is gigantic. I would argue, with the metals pricing in a slow motion way on busy news days moving from west to east. As I've said before, this is deeply symbolic of economic power shifting from west to east. So Matthew Chamberlain is facilitating this whole transition here. Some warehouse firms have been concerned about the cost of storage in Hong Kong, so it doesn't even seem like it's that cost effective. Interestingly, quote, given the cost of land in Hong Kong, it will likely require additional government support to allow the warehouse to be built, end quote, Arthur Fan, head of Asia Pacific at brokerage Merrick, said in a statement. Quote, however, overall, we believe that this step will be welcomed by metals buyers in China, end quote, Fan added. So maybe metals buyers will be happy, but is this a good business decision? Chamberlain said rent will be higher at LME warehouses in Hong Kong, but investors will benefit from the proximity to mainland China. Quote, we absolutely recognize that Hong Kong is a higher cost jurisdiction, but the LME structure already reflects this, end quote, he told Reuters. In an internal presentation more than a year ago, the LME said the warehouse rents would have to be subsidized by the Hong Kong government to make it commercially viable. However, Chamberlain said on Monday that no financial incentives for international warehouse companies have been agreed with the Hong Kong authorities so far. Quote, we believe strongly the LME warehousing is economically attractive in all of our locations around the world, and it should be the same in Hong Kong, end quote. So, I don't understand what the incentive is for the LME to move to Hong Kong if it's more expensive. I don't understand the business case here. Like, maybe there's a sense that maybe higher volumes, or maybe there will be a subsidy that gets introduced by Hong Kong. Again, what's the business case here? And frankly, it looks like there is no business case. This is about Matthew Chamberlain doing the bidding of Hong Kong Exchanges and Clearing to move the LME to China. That's what it looks like to me. So LME in name only is what this looks like to me. And frankly, it's probably been that way since 2012. I mean, if you're going to let Hong Kong Exchanges and Clearing buy the LME, I mean, what do you expect? You can't even blame them. Okay, this is what happens. Continuing on, another huge story we're following is Korea Zinc, and things are coming to a head. And I have this summary here from the Korea Herald. Korea Zinc power struggle in 2 minutes, because we are bringing ourselves up to date on this very important story about the world's largest refined zinc producer, and they also want to produce antimony for the United States. So this is no small matter. Of course, the Chinese government recently banning antimony exports to the United States in December. So here it is. Korea Zinc, the world's largest refined zinc producer, valued at $12 billion, is locked in a high-stakes battle for managerial control that could impact South Korea's economy and global supply chains. So here are the key players. The first is Korea Zinc, who are the Choi family. And founded in 1974 and managed by the Choi family, Korea Zinc has diversified under CEO Choi Yun-byum, moving into battery materials and renewable energy. And you wonder if this is the source of their issues with battery materials doing so poorly. The other main player is Yongpeng Group, or the Chang family, the company's largest shareholder, operating the Seokpo smelter and facing financial difficulties. Allied with MBK Partners, a private equity firm for facilitating major deals in South Korea. And the third player is Bain Capital. Now, this is something I got wrong last episode. I thought I had read that Bain Capital was associated and was part of MBK Partners. But that is not the case. Bain Capital is actually allied with the Choi family, in other words, with Korea Zinc's current owners, to defend Korea Zinc from a takeover. And here's just a little bit about the conflict between the two major parties there. The feud traces back to the late 2010s, when Yongpeng, who is the Chang family, or MBK, increased its influence over Korea Zinc through restructuring, creating tension with CEO Choi Yun-byam, the Korea Zinc people. The conflict escalated when Korea Zinc stopped processing sulfuric acid byproducts from Yongpeng's Seokpo smelter, citing safety and cost concerns. By September last year, the battle reached a boiling point when Yongpeng MBK launched a $1.7 billion tender offer to acquire more Korea Zinc shares. Korea Zinc countered with a share buyback, raising its stake to 35% with Bain's support. On November 11th, MBK purchased an additional 1.36%, bringing the Yongpeng MBK alliance to 40% ownership, but still leaving no clear winner. And so here are the recent developments. On November 1st last year, South Korea's Supreme Court ordered Yongpyeon's Seokpo smelter to close for 2 months over unauthorized wastewater discharges, potentially weakening its position. So Yongpyeong is allied with MBK, and these are the people that want to take over Korea Zinc. And the Supreme Court shut them down for 2 months over unauthorized wastewater discharges. Korea Zinc canceled a controversial share sale on November 13th last year following a backlash in regulatory scrutiny. CEO Choi Yun-byam also stepped down as board chairman. And on January 6th, the state-run National Pension Service reduced its ownership in Korea Zinc from 7.5% to 4.5%, signaling a reduced role as a potential swing vote. And here's what's at stake. Korea Zinc produces 85% of South Korea's zinc, vital for steelmaking and semiconductors. Prolonged instability risks major supply chain disruptions. Korea Zinc is crucial to reducing reliance on Chinese metals, aligning with U.S. strategic goals. The fight exposes flaws in South Korea's chaebol system, where family-run conglomerates often prioritize internal power dynamics over stakeholder value. And finally, here's the risk in this story by Korea Herald. Korea Zinc risks straining its finances with further buybacks, while Yongpeng's MBK's potential control raises concerns over prioritizing short-term gains. The stock remains volatile. And so here's what's coming. The decisive moment is expected at the extraordinary shareholders meeting on January 23rd, which is Thursday, where leadership control may be determined. Korea Zinc may cancel repurchase shares to boost its stake to 40%, closing the gap with Yongpeng MBK. So it seems like there's a bit of a rivalry going on in Korea, but the stakes, as I was mentioning last episode, are simply far too high for this rivalry to compromise this incredibly important smelter. You know, the West is already incredibly behind. This is allied with, as it says here, the U.S.'s strategic goals. As I said last week, it cannot afford to lose this asset to some, rivalry here. So a dramatic week coming up here for Korea Zinc. Another interesting headline, GM inks multi-billion-dollar deal for synthetic battery materials that would bypass China. This is the Detroit Free Press. And just a couple of lines here, General Motors has inked a multi-million-dollar deal with a Norwegian battery supplier for its synthetic graphite anode materials starting in 2027. The company said Wednesday that once Vianode launches production in North America, the deal will run through 2033. Quote, this project will help advance our battery technology and drive greater value to our customers, end quote. Jeff Morrison, GM's Senior Vice President of Global Purchasing and Supply Chain, said in a statement, quote, the entire EV ecosystem depends upon the import of one critical mineral, end quote, Vianode CEO Burkhard Straube said in an interview with Reuters. Quote, what General Motors wants, and we want, is a resilient supply chain for North America, end quote. And of course, in December, along with super hard metals, China restricted the export of graphite. And that was announced along with the ban, just a restriction. But as we've seen in the past, the restriction of exports is the first step towards an all-out ban. So just a couple of more lines here. In its first planned phase, the plant, which could be in the US or Canada, should produce around 80,000 tons of synthetic graphite annually by 2030, or enough to supply around 1.5 million EVs. Vianode already has a production plant in operation in Herøya, Norway. And as it says here, final line of the article, China controls 95% of the global supply of graphite. So, super interesting development there, courtesy of the Detroit Free Press. Couple of other headlines here. U.S. offered infrastructure incentive for DRC-Rwanda peace deal. And I found this almost kind of humorous here. According to Agence France-Presse on France24.com, the United States offered to extend its signature African investment project into the troubled east of the Democratic Republic of Congo, the Libido Corridor, into the troubled east of the Democratic Republic of Congo as an incentive for a peace deal. But Rwanda has backed away, a senior U.S. diplomat said. So the U.S. trying to extend the Libido Corridor into the eastern DRC, and I guess I'm not surprised that Rwanda is not excited about the deal if, in fact, a lot of these 3T minerals, as they're called, are being laundered through the country, as the DRC has been claiming. And so we have a quote from Molly Fee, the outgoing Assistant Secretary of State for African Affairs, who said, quote, "We had proposed to both sides that if we could get stabilization in eastern DRC, we could work on developing a spur from the Libido Corridor up through the eastern DRC," end quote. She also said, quote, "We tried to offer positive incentives, a genuine framework, fundamentally negotiated by the parties, and at the moment, Rwanda seems to have walked away," end quote. So I can't say I'm too shocked on that front. Interesting development there. And here is another headline, courtesy of mining.com. Hummingbird reaches $16.4 million deal with Mali over Yan Falila mine. This is Cecilia Jamasmi at mining.com. As it says here, Hummingbird Resources announced on Wednesday it had reached an agreement with Mali's military-led government, and so they are giving $16.4 million, and which is to be paid in 2 settlements. So we'll see if that works out any better for them than it did for Barrick. Also in West Africa, France's Orano files second arbitration procedure over Niger uranium crackdown, so another arbitration procedure. This is nukenet.org. And meanwhile, Orano gets go-ahead from Mongolia for $1.6 billion uranium mine. So Orano shifting its interest out of Niger towards Mongolia. And that was a Bloomberg News headline via mining.com. And moving over to Myanmar, where we've been following this very interesting situation with rare earths in Myanmar and the military groups, we have a headline from TribuneIndia.com. Myanmar military armed group signs ceasefire agreement, says China. So there has been a formal ceasefire agreement that has been signed, which came into effect on Saturday, halting the constant fighting, Chinese Foreign Ministry said on Monday, as reported by Xinhua. So China brokers a ceasefire in Myanmar with the rebel groups, quite interesting. And finally, just an update on BYD, which again is the case study here of what happens when you dominate metals processing. Here's electric.co, just a headline. BYD is about to open another massive EV plant overseas with 150,000 vehicle capacity, and this will be going up in Indonesia. Another headline, courtesy of Electric, BYD beats Toyota in electric vehicle sales on its home turf in 2024. So BYD outsells Toyota in electric vehicles in Japan. And finally, BYD just launched the world's largest car carrier to charge up its global EV ambitions. And what you see here is a gigantic ship with a BYD logo on it. So as you see, they completely own the vertical supply chain, so to speak, from the metals all the way to even owning the ships that send out the cars. So pretty fascinating. So coming up, we have CPM Group Managing Partner Jeffrey Christian on gold, the impact of higher interest rates, how much physical gold is selling, the impact of the strong dollar, and more on the gold market. So fascinating interview with Jeffrey Christian out of CPM Group in New York. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. And turning to the website, a few stories on Saudi Arabia. I suppose this is the result of the Future Minerals Forum conference that just occurred in Saudi Arabia, because we are getting quite the trickle here, and it really sounds like Saudi Arabia is getting more invested and, frankly, more aggressive about ensuring its position in minerals and metals, as you're going to see here. So let's start with this story by Cecilia Jamazmi on mining.com. Saudi Arabia to scale up lithium expansion as it diversifies from oil. Saudi Arabia has announced a new joint venture between Aramco, the world's largest oil company, and state-owned mining company Ma'aden, making a significant step in its push to dominate critical minerals. The partnership aims to extract lithium, an essential component in electric vehicle and electronic devices, from high-concentration deposits while exploring cost-effective direct extraction technologies. Commercial lithium production is expected to commence by 2027, the company said. And here's a quote from Aramco's president of exploration and production, Nasser Al-Naimi, who said in a statement, quote, "We expect that this partnership will leverage the world's leading upstream enterprise with a view to meeting the kingdom and potentially the world's projected lithium demand," end quote. The announcement aligns with Saudi Arabia's Vision 2030, an ambitious initiative to reduce dependence on oil by developing its mining sector and other industries. The plan targets $2.5 trillion in untapped mineral resources and seeks to increase mining GDP contribution from $17 billion to $64 billion by 2030. Demand for transition minerals such as lithium, cobalt, and nickel is surging globally. Aramco forecasts a 20-fold increase in domestic lithium demand between 2024 and 2030, sufficient to support 500,000 electric vehicle batteries and 110 gigawatts of renewable energy sources. In December, Aramco, Saudi lithium startup Lihitek, and Ma'aden announced the country's first successful lithium extraction from oil field brine. Continuing on, we have another story. Ma'aden to open office in Brazil, invest around $1.3 billion. This is Reuters via mining.com. Saudi Arabia's Ma'aden, the mining arm of the Crown Prince's Public Investment Fund, plans to open its first office in Sao Paulo, Brazilian mining minister Alexandre Silveira said on Tuesday. The initiative includes an estimated 8 million reais, or $1.13 billion, to advance geological mapping in Brazil, Silveira told reporters in Riyadh. Quote, "We need to know more about our subsoil and partner with the Brazilian mining sector so that we can explore and take advantage of the subsoil in a sustainable, adequate way," end quote, he said, emphasizing that mining along with oil and gas is critical to the global energy transition. The investment aligns with Saudi Arabia's Vision 2030 strategy to diversify its economy, leveraging its expertise in mining and sustainable energy. Continuing on, Congo courts Saudi mining investors to help curb China dominance. This is Reuters via mining.com. The Democratic Republic of Congo, the world's top cobalt supplier, is courting new mining investors from Saudi Arabia to help it diversify and curb over-reliance on companies from China, Marcelin Paluku, a senior government official, told Reuters. Congo, which is also rich in copper and other critical minerals, wants more partnerships with the new investors to limit the risk of relying solely on Chinese investors, Paluku, who is a deputy cabinet minister in the Ministry of Mines, said. Chinese companies, some of which are state-backed, have over the past years emerged as the biggest investors in Congo, ramping up investment and production for copper and cobalt. CMOC Group is now the world's biggest cobalt miner as it boosts output at Tenke Fungurume mine it bought from U.S.-based Freeport-McMoRan in 2016. Paluku said Chinese investors' dominant role in the sector now presents a quote-unquote risk to the country's economy. Quote, "Today, 80% of our mines, it's with one partner, China, so it's a risk," end quote, Paluku told Reuters in an interview on the sidelines of the mining conference in Riyadh. Quote, "You never know what can happen, so that means we're now trying to diversify our partnerships so we don't rely on one partner," end quote. Congo is also courting investors from the European Union and India, Paluku said. The country is seeking to move away from current joint ventures, which are heavily skewed in favor of investors, he added. Quote, "We are talking to all the people who are open to doing business with us," end quote, Paluku said. So very interesting. I mean, we saw this story with CMOC. I mean, it sounds like they're flooding the market with cobalt, and meanwhile, China has announced that they are stockpiling cobalt. So in a weird way, it is suppressing the price of cobalt, and China basically is just buying all the cobalt out of DRC at rock bottom prices. So maybe that is part of what this is about. It doesn't explicitly say it here, but one imagines they're kind of aware of what's going on. Let's continue. Zambia looks to UAE and Saudi Arabia to back copper expansion. This is Bloomberg News via mining.com. Zambia aims to increase copper output to a record above 1 million tons this year as it deepens ties with oil-rich Gulf nations such as the United Arab Emirates and Saudi Arabia. Production may climb from 720,000 tons in 2024, according to Hito Kayumba, Special Assistant for Finance and Investment to Zambia's president. And here is a quote from Kayumba. Quote, "The UAE is aggressively pursuing new investments, and the MOU, or Memorandum of Understanding, with Saudi Arabia tells you how serious the relationship is. They will definitely be in Zambia." Very interesting there. Of course, Zambia in the copper belt. Another headline, Zambia says Saudi's Manara interested in its copper assets. This is Reuters via mining.com. Saudi Arabia's Manara Minerals is looking for critical minerals projects in Zambia to invest in, the southern African country's mines minister Paul Kabuswe told Reuters on Thursday. Manara and Africa's second-largest copper producer held talks on Wednesday after signing the previous day an MOU with Saudi Arabia to cooperate on exploration for new minerals. Quote, "Manara are interested, but we do not know which ones yet," end quote, he said on the sidelines of a mining conference in Riyadh, adding that an announcement on a potential mining deal between Zambia and Saudi Arabia is likely this year. Saudi Arabia is among several Middle East economies pursuing deals in critical minerals, including copper and lithium, as part of de facto ruler Crown Prince Mohammed bin Salman's strategy to wean the economy off its dependency on oil. And here's an interesting detail scrolling down a bit. This is Paul Kabuswe, the country's mines minister. Quote, "We no longer want those agreements where we have 10 or 15%. End quote, he said, adding that the government is also holding talks with Barrick Gold, Ivanhoe Mines, and Chinese investors on their plans for new projects. As it says here, a new push by Zambia's government to negotiate shareholdings as high as 30% in new mining projects has not impacted investor appetite, although investors have had mixed feelings. So, at least here, rather than what we see in Mali, it sounds a bit more collaborative, shall we say. Continuing on, Rio Tinto to form new lithium unit after Arcadium buy. So this is Reuters via mining.com. The world's second largest miner, Rio Tinto, plans to create a standalone lithium division after it closes its $6.7 billion acquisition of Arcadium Lithium, according to an internal memo seen by Reuters. The plan reflects how closely tied Rio CEO Jakob Stausholm and his leadership team believe lithium is to the company's future, and the high value they place on Arcadium's engineers as part of the deal. The new business, Rio Tinto Lithium, will assume control of Rio's $2.5 billion Rincon project in Argentina, but not its controversial Jadar lithium project in Serbia. Very interesting. The deal is Rio's largest in more than a decade. Continuing on, Rio Tinto and Glencore spoke for months about deal that was once taboo. This is Bloomberg News via mining.com. And it says that there was a proposed merger in place earlier. And here's the article. When Glencore proposed a combination with Rio Tinto Group a decade ago, the larger company turned it down after just a few days. News this week that the two spent several months in negotiation in the second half of last year shows how the sands have shifted, just as mega deal fever sweeps the global mining industry. Rio's firm and immediate rejection in 2014 of what would have been the largest ever deal in the global mining industry kicked off a months-long public feud that made painfully clear a vast gulf between the two companies' cultures. Glencore boss Ivan Glasenberg accused Rio of misunderstanding the iron ore market, while his counterpart at Rio criticized Glencore's traders as short-termist. But when Glencore reached out about a deal last year, it met with a very different reception. This time Rio was open to talk. What followed was a prolonged period of exploratory discussions at the top level of both companies, according to people familiar with the matter. The circle was kept very small, they said, but Rio Chief Executive Officer Jacob Stausholm and Glencore's Gary Nagel had conversations over multiple months starting in the autumn. Rio Chairman Dominic Barton was also directly involved, some people said. Now, the BHP Anglo-American deal, one could argue, was very much short-circuited by its leaks to the media. It kind of screwed up the whole deal, I would argue, so it's quite interesting how this was occurring and didn't really come out. It wasn't leaked. They must have kept it incredibly tight, as it is saying here. So it sounds like they're willing to talk, but really nothing more than that has really been announced. So interesting story there from Bloomberg. Continuing on, just a few more headlines. Tech earmarks up to $3.9 billion to boost copper output. This is Cecilia Jamasmi at mining.com. And this is going to be focused on, quote, low-complexity key projects across Chile, Canada, Peru, and Mexico, end quote. Another headline, Barrick's Reko Diq project to generate $74 billion over 37 years, according to Mark Bristow. And of course, that is the project that is in Pakistan that Barrick owns 50% of, and it is a copper-gold project. It is thought to be gigantic. And as it says here, the Saudis, through Manara Minerals, want to be involved in it. As it says near the end, the project has gauged interest from global investors, including Saudi Arabia's Manara Minerals, a joint venture between state-controlled miner Ma'aden and the $925 billion public investment fund. And it says, Bristow has said that Barrick would support any decision made by the Pakistani government in collaboration with the Saudis, but the company will not dilute its equity in the project. So interesting there. Another headline, TMC shares surge as support for deep-sea mining grows ahead of Trump presidency. And they surged 22% last week. And just a few more headlines, EU to propose ban on Russian aluminum imports, a new sanctions package. And another one, aluminum price rallies with possible EU ban on Russian supplies. That's Bloomberg News. Also, EU environment chief sees opportunity in recycled raw materials. This is Bloomberg News. You know, that is a good idea. Like if the EU at least could become a leader in recycling of raw materials, at least it would be something. And a couple of headlines out of Australia. Australian government pledges $1.24 billion in green aluminum push. This is from Reuters via mining.com. So pushing for green aluminum. Also, Arafura Rare Earths gets a $124 million boost from Australia. This is Bloomberg News via mining.com. And this is from Australia's National Reconstruction Fund to support a new mine and processing facility. The latest move by Western nations to boost supply chains of critical resources amid a strategic contest with China. So interesting developments out of Australia. And finally, China State Grid plans record $89 billion spend amid green surge. And this is Bloomberg News via mining.com. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. Yields coming down. The U.S. 10-year bond is yielding 4.56%. That is down 0.21% from last week. The UK 10-year gilt is yielding 4.59%. That is down 0.29% from last week. The Italy 10-year bond is yielding 3.59%. That is down 0.22% from last week, and the German 10-year Bund is yielding 2.48%. That is down 0.12% from last week. And the Japanese 10-year bond is yielding 1.19%. That is down 0.05% from last week. So a bit of respite for the bond market, but really yields are still quite elevated relative to where they've been. So it's going to be super interesting to see how this plays out, as there seems to be an inverse correlation between bond yields and the stock market. Yields coming down, the market performs well. So very interesting. Let's see how precious metals are doing. Gold is trading at $2,760.10 per ounce. That is up $81 from last week. So gold jumping. Silver is trading at $31.44 per ounce. That is $1.14 per ounce higher. Platinum is trading at $946.90 per ounce. That is $12 lower than last week. And palladium is trading at $937.50 per ounce. That is $7 higher than last week. Turning to industrial metals, copper is trading at $4.29 per pound. That is unchanged from last week. Iron ore is back above $100 at $101.21 per metric ton. That is $3 higher than last week. Aluminum is trading at $1.22 per pound. That is 5 cents higher than last week. Lead is trading at 90 cents per pound. That is 2 cents higher than last week. Nickel is trading at $7.29 per pound. That is 8 cents higher than last week. And tin is trading at $13.51 per pound. That is 3 cents lower than last week. Cobalt is unchanged at $11.02 per pound. Lithium is slightly higher at $10.65 per kilogram. That is 29 cents higher than last week. Uranium is slightly higher at $73.95 per pound. That is 40 cents higher than last week. And zinc is higher at $1.34 per pound. That is 4 cents higher than last week. Zooming out, interesting moves. Gold and silver really standing out in the precious metals, jumping. Platinum and palladium, edge sideways more or less. Seems industrial metals are more or less a mixed bag, edging sideways. I would say a wait-and-see market is what this looks like. And should the market take off, one imagines industrial metals will go along for the ride. And should the market crater, perhaps the metals will as well. So a bit of a wait-and-see market here in commodities to see how probably the inauguration of Donald Trump will play out. And those are your metal prices. Coming up, I'm very pleased to welcome back to the program Jeffrey Christian, managing partner of CPM Group. We discuss all things gold, the dollar, interest rates, the Fed, and more. It is a fascinating discussion as usual. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the Northern Miner Podcast, Jeffrey Christian, managing partner of CPM Group. Jeff, how are you doing?
I'm good. Happy New Year, Adrian. I hope you're doing as well as I am. 2025 shaping up to be an interesting year.
Well, you've done remarkable being involved in the gold market for all this time, so I hope I'm doing as well as you are as well. So Happy New Year to you, Jeff. Always wonderful to talk to you. Quite a lot on the menu here in terms of the gold market, which continues to be particularly interesting. We have this news story that came out, though. I'm kind of curious if you have any commentary here with this, the Mali junta seizing $245 million of gold from the Loulo-Gounkoto complex. Do you have any experience in West Africa? Do you have any thoughts on what is occurring?
Yeah, I have a lot of experience in West Africa and Central Africa with mining and mining issues. In fact, I was involved with the creation of the Syama mine, which was one of the first current generation gold mines in that region. And I worked with the African Development Bank and the IFC on these things for a long time. And one of the issues that I've been cautious about really for the last 3 decades has been resource nationalism and the rise of resource nationalism, which has become ever more prevalent and important and more problematic. At the same time, you have political issues in the Sahel, the sub-Saharan portion of Africa, which includes Burkina Faso and Mali and some of these other countries that have gold mines run by Western entities. And that has become much more divided politically. You have a rise of Islamic militancy there, and you have the advent and arrival of Russian mercenaries, for want of a better word. They're now owned and operated by the Russian government that have come in there and supported military coups and take their payment in gold, by and large. So it's gotten to be a lot worse. And it's kind of funny because when I was in university, one of my big papers was looking at the political situation in Africa in the 60s when Russia and China and the United States were playing like a chessboard. And, the Chinese were supporting revolutionaries and coup throughout Africa and supporting people like Kwame Nkrumah. So, I actually studied this stuff from a historical perspective. And I guess what I'm saying is we're back there. So you've got resource nationalism, which is a global problem right now, but it's particularly present and it's problematic in this case and in Africa in general. And you also have the involvement of the Russian mercenaries in running these governments, kicking the French military out of Cote d'Ivoire, kicking the US military out of various countries. So it's a political hotbed, and Barrack is a victim of that.
It all rings true the way you describe it. And it's kind of a slow motion trend. You might call it a mega trend, this resource nationalism issue. Put it this way, it seems like the noose, for lack of a better term, is tightening.
Yes.
That this, right? Like the trend is continuing towards
I would
resource
say
nationalism.
I would say it has been a slow burning problem, and the noose has been tightening slowly, and the writing was clearly on the wall. But I think that you now have all of these things accelerating and becoming much more problematic in an immediate sense. And I think that that's been happening in the last year or two. And I think it's going to accelerate further in 2025 going forward because there's a certain momentum that's catching up, and there's a clear deterioration of the political and economic power of the United States and various European governments within Africa and on a global basis, which is allowing an acceleration of this resource nationalism, which, let's be honest, the United States and various European countries are also engaging in resource nationalism too.
Sure. I mean, we see U.S. Steel, could be considered an example of this, right?
It's exactly an example.
And
Yeah.
so, just finally on this point, like as I research this topic and consider it here week after week, it seems to me that the real solution at the end of the day, from the Western point of view, the issue is the not as much, I would say, the metals themselves, is actually the processing of the metals. And it's sort of just like the cobalt market. Of course, most of the cobalt is famously produced in the Democratic Republic of Congo, but who runs the cobalt market? Who dominates it? It's China because they dominate the refining, which, says to me that ultimately the issue that the West faces is actually more in regard to the metals processing than producing the metals themselves. Do you have any thoughts about that?
Yes and no. I mean, producing the metals themselves is very important. The value added in beneficiation, processing these materials is enormous. And it's something that developing countries historically have not achieved. It's true in metals, but it's also true in energies. It's true in agriculturals. I mean, until maybe a decade ago, all of the cocoa produced in West Africa was basically processed in North America, Europe, and a couple Asian countries. They would grow the cocoa, they would harvest it and dry it, and then they would ship it offshore for beneficiation. So all of the value added of processing those materials accrued offshore. And the same is true, in other metals around the world. So that's one of the issues. But there are also the issues of ownership and operation of the mines. I happen to assume, knowing Barrick and knowing Mark Bristow, I cannot imagine that they violated the terms of their agreements with the Malian government on operating this mine. But you have to assume that you're going to have hostile situations with these countries.
Yeah, I mean, what a drama going on over there. I mean, for almost a year, it's gone back to April when we first started hearing
Mhm.
rumors, courtesy of the Africa report, of Wagner wanting to take over that complex. So Kind of interesting. It wasn't accurate, that story, but it was almost right in spirit if, in fact, the gold is ending up with Wagner at the end of the day. Another huge story that we're seeing develop here, which arguably has implications for the gold market, is the bond market. We're seeing yields rise, I suppose you could say fairly dramatically. I never like to overstate things with you because I know you're sensitive to language and in the best possible way, actually, in the spirit of accuracy. But we do have a pretty significant rise in, say, US bond yields almost across the whole, at least across, a lot of the major bond markets we see in Europe. We see in the UK almost 5% there. We see even in Japan. I saw 1.25% yesterday. So, what are your thoughts on the bond market within the context, I guess, of gold itself?
Well, yeah, okay. Let's talk about the bond market first and then the bond market as it relates to gold, because it's very interesting what the gold relationship to the bond market and the dollar right now. And a lot of people don't seem to understand the reality of the numbers. And yes, I'm sensitive to words, but I'm also sensitive to numbers. And one of the things to pay attention to in the bond market and the sensitivity for words and numbers is I view everything along a spectrum. And there are so many people who think in terms of black and white. 20 years ago, I used to give speeches where I would talk about this and say, the world actually exists in 50 shades of gray. But I had to stop saying that and just say it's a spectrum. But interest rates are rising, and they're probably going to continue to rise because 2025 is going to see a much more hostile economic and political and financial environment. In the commodities markets, we talk about environmental issues, and what we mean are political, economic, and financial market conditions. That's the environment in which commerce is done. And we're going to be in a much more hostile environment in 2025 and probably for the next several years. And in that environment, you will probably see upward pressures on interest rates. There's been a tremendous amount of debt taken on globally. People tend to look at the US federal debt, which is now $36 trillion, and say this is untenable, but they don't understand that the US Treasury is the most credit-worthy borrower. So one of the things that we've seen over the last couple of years with the strength of the dollar, which a lot of people said the dollar cannot be strong because of the enormous debt that the federal government's taking on and all of the problems within the United States. But all of the problems within the United States are relatively less problematic than the problems in other countries, around the world. And the Treasury has a better credit rating than other governments. So sovereign debt in other countries, generally speaking, is downgraded relative to treasuries. And private debt, corporate debt, and consumer debt, it has an even worse credit rating. So what you see and what you've been seeing is that the federal government in the United States can get away with inappropriate deficits because people around the world are buying dollars so that they can invest in US treasuries because the treasuries have a better rating. Now, treasury rates are rising because people who lend money are demanding more security to take on the increased risk that deterioration of the environment has. But they're also rising around the world. And if you think about it, you've got U.S. Treasury debt, which is about 100% of U.S. GDP, $36 trillion. Oh my God, that's really a bad shape. But then you look at it on a global basis and you throw in corporate debt and personal debt, and you've got like more than $3 trillion worth of debt. And you've got this enormous amount of debt that doesn't have the U.S. Treasury credit rating because everybody has been borrowing as much as they could, but you have this enormous debt problem. That doesn't mean that it's a debt bubble that's going to burst and the world's going to throw itself into a depression, because things happen along that spectrum. It's not black and white. Oh, we can't have economic growth, therefore we're going to have a depression or severe recession. It's a matter of spectrum. So you're going to have to see contractions in economic growth, higher costs of borrowing money, and increased tensions on a global basis because of the rise in debt. Debt has a lot to do with it, along with other factors. I don't want to downplay other political and economic factors, but that's one of the factors. So we expect interest rates to be continuing to rise. They're going to be problematic for monetary authorities like the U.S. Federal Reserve Board, but that doesn't mean that we're going into this catastrophic period. It means that we're going to have a year where the consequences of past largesse and mismanagement start to come home and have to be dealt with in a much more serious way at exactly the time when political leadership is deteriorating in its capacity to deal with things like this in a responsible fashion.
You mentioned the Federal Reserve, and I'm kind of curious. I mean, you've been following, the Fed for decades, and I'm kind of curious, like, what your take in maybe kind of how they might be thinking about this, because they were at least cutting interest rates, yet the bond market was going higher. How big of a problem do you think they think that is, or is it a problem for them?
They see it as a problem, but it's a problem that right now could be manageable. You know, I think part of the problem, and yeah, I've been following, this is the 50th year in which I've been writing about commodities. The first thing I wrote about commodities was in 1975, and it had to do with oil. So yeah, I've been following this stuff for way too long. But if you look at the Fed, it's a human institution. And from 1950 to 1971, William McChesney Martin was the Fed chairman. And he was like, they say he was born to be the Fed chairman. His father was a banker and raised him in that frame of mind. And the Fed did an extraordinary job in an extraordinarily difficult period of time when we had fixed exchange rates, $35 per ounce for gold, dollar fixed against gold, other currencies fixed against the dollar. It was a nightmare, and he did a very good job. He retired in 71, and from 71 to 79, we had a series of less competent Fed chairmen who were really political beasts. And we saw 14% inflation. We saw two recessions, severe recessions. We saw all sorts of economic problems. And there were other things happening. And the Fed was really mismanaging monetary policy in the face of deregulation of corporations, deregulation of interest rates, deregulation of the lending markets. And in 1979, Paul Volcker came in, and he and then Greenspan were extremely good Fed chairmen. And since that time, we've had three Fed chairmen who have been good, much better than what we saw in the 70s. And Powell actually has done a very good job over the last several years. Gold bugs trash him, but then he knows more than they do. Yeah. Gold bugs, generally speaking, don't like people who get the market right because they consistently get the market wrong. We are now looking at a Trump administration coming in talking about, we don't like Jerome Powell because he's an independent central banker who won't necessarily do what we want him to do. So we are at risk of getting a Republican political appointee in the Fed chairmanship at some point over the next year or two. And that could really hurt the creditworthiness of the United States Treasury and the credibility of the dollar in the Treasury market.
Right. So, in a hypothetical, and I hesitate to do a hypothetical here, but let's say we saw interest rates go up. In the past, you've told us that ultimately this is not great for gold if interest rates go higher because people would rather park their money, say, and get a high interest rate, if I'm not mistaken on that. So, if interest rates were to go higher, would you see this as hurting the gold market?
Not necessarily, because part and parcel, what ultimately matters is why are interest rates rising? And if inflation is rising, if inflation starts rising, right now we're at a point where the 10-year treasuries are approaching 5%. Inflation is hovering a little over 3%. And we'll see the CPI later this morning, so we'll see where it is. But it's a little over 3%. That means that you have a real inflation adjusted 10-year interest rate of less than 2%. there are very few investors who say, "Ooh, I can lock in an inflation adjusted interest rate of 2% for the next 10 years." They're not going to do that. What they might do is say, "I can get 4 or 4.3% for 2 years or for 1 year, and I'll take that because I think that a year from now, maybe the interest rate's going to be higher and inflation is going to be lower." So what really matters is, why are interest rates rising and how high are they rising? If you look at the correlation between month-to-month changes in T-bond prices and gold prices, it's zero. If you look at the correlation between when are they rising together or falling together, or one's moving up and the other one's moving down, it's a negative 16%. So the idea that higher interest rates are negative for gold is invalid in total. And you have to look and disaggregate it and say, why are interest rates rising? And if interest rates are rising because people around the world are concerned about inflation and they don't know that monetary authorities can control it, and they don't think that fiscal authorities, governments, can control their deficit spending, then that's good for gold. If they think that interest rates are rising because the monetary authorities can get inflation under control and bring it back down, that's bad for gold. I lean right now into the latter category on the short term, but the former category in the long term. So I think that right now, if you see interest rates rising, it's because the Fed is working to try to contain the inflationary pressures caused by fiscal policy and macroeconomic trends and supply and demand of goods and services within the United States. I'm not sure that that will be the case a year or two from now, in which case I think that interest rates could be rising because things are the consequences of past largesse and current largesse are coming home to roost. So I think that right now, rising interest rates are pretty much neutral for gold, because even though interest rates are rising, the real inflation adjusted rate is still too low to cause investors to say, I don't need gold, I can switch to treasuries. So I think it's neutral right now. And later, a year or two from now, it may be positive for gold, because the economic and social consequences of all of these economic and political issues will be much clearer to consumers and corporations and governments and voters.
Right. So the key issue, of course, then is real interest rates and that 3% threshold that we long discussed. Would that
Exactly.
excellent. So, a couple of other issues I want to touch on before we go. There's two things. There's the new US president coming in, and there's also this huge run in the dollar, which perhaps is kind of related, which is why I kind of put these two issues together here. I mean, it's been remarkable being in gold, right, in the last year, because not only has the price gone up, but the US dollar is outperforming many other currencies, if not all other currencies right now. How
Mhm.
are you seeing the US dollar, and if it relates at all to the election and the new president? What are your thoughts over there?
I think the US dollar strength is predicated primarily on the fact that, as I mentioned earlier, the US creditworthiness is better than other governments, private debt, corporate debt, consumer debt. So I think that there's a tremendous interest in investing in US assets on a global basis. And you have foreign investors buying the dollar so that they can invest in the US stock market, they can invest in US real estate, they can invest in US corporations, they can invest in treasury bills. And it's funny because you'll hear again, the gold bugs will talk about how no one's buying the treasuries and people are dumping treasuries. Treasury holdings overseas are at record levels. They rose above $8 trillion at the end of 2023, which was a record amount of US Treasury debt held offshore by non-US holders. Some of those were US corporations, pension funds, and wealthy individuals who were holding their money in US Treasuries offshore for tax avoidance purposes. But that's beside the point, or for investment purposes. But you had a record amount of Treasury bills held overseas at the end of 2023. They rose about 10%, the holdings, over the course of 2023. The last time I looked was in November, and the 12 months leading through October of 2024 saw a 15% increase in Treasury holdings to something like $8.8 trillion. So you've got investors around the world buying dollars in order to invest in U.S. assets, including U.S. Treasuries. And that's why the dollar's rising. As long as the U.S. looks to be a better place to invest than, say, Mali, or pick a European country, Germany, Austria, France, or pick a country in Asia, China. As long as the U.S. is a more attractive place in which to invest, the dollar will do well at the expense of other currencies.
Okay, excellent. And as far as the physical gold market, like we've discussed that in the past as having a kind of importance in the long run. Is there anything you're seeing over there in terms of physical gold demand? Like, would you call it fairly healthy from what you're seeing? Is it very strong? Is it sort of, neutral? What are you seeing in that regard?
We're seeing strong demand for gold in most physical gold in most parts of the world. In terms of central banks have pulled back a little bit last year. If central banks bought about 14 million ounces in 2023 on a net basis, in 2024, their purchases were closer to 8 million ounces. That's a response to the price. Well, it's a response to two things. And there's one of the things which actually affects the dollar, which I should have mentioned. Central banks have been using their reserves to prop up their economies. So their holdings of some central banks were actually sellers of gold last year to raise cash. And they also were drawing down their US dollar holdings to support their economy. So you saw central bank holdings of dollars decline. You saw central bank holdings of gold rise, but at a slower pace than in 2023, the slowest pace since 2020. That reflects, the fact that central banks were working on other things and they were spending their dollars on other things other than buying gold. But it also reflects price sensitivity. The gold price was 23% higher last year than it had been the year before, and it was at record levels. And central banks are more value investors than private investors, so they actually pulled back. Now, on the private basis, you saw a 36% increase in the amount of physical gold bought by investors, non-central banks, non-monetary authorities. Private investors, including sovereign wealth funds, bought 36% more gold last year. They bought about 33 million ounces of gold last year, including North American institutional investors. There are people who go around saying that North American institutions did not participate in the gold market last year at the same pace that other people did. And that's not accurate. They actually were buying. They just weren't telling people they were buying. You saw about a 33 million ounce increase of net purchases by investors last year. Our expectation is that rises further this year because of all those factors I was talking about in terms of economic and political problems.
Okay, excellent. And just as we wrap up, just a quick, look at the metals. Of course, you guys follow a lot of the metals. Kind of curious to see, as far as you can gauge it, what you kind of think the year has in store for us, in regard to, say, precious metals. Like you've talked a little bit about silver on your YouTube channel. I mean, do you expect silver ultimately to be the great performer out of the precious metals and also, industrial metals? Are there any metals that are really sticking out to you?
The metals that we're most interested in from an investment perspective are silver. We're looking at about an 18 to 20% increase in the annual average price of silver this year, and gold. And we're looking for a 12% increase in the annual average gold price this year. So those are probably the two best performers. We are somewhat bullish on some metals like copper and all, but insofar as we're looking at higher interest rates, increased economic uncertainties, the potential of a recession at some point on a global basis, we're less interested in industrial metals in terms of 2023. One of my contacts last night was explaining how he keeps emphasizing that he is an intermediate to long-term bull on certain metals, but he is very skeptical that prices will rise in the short term. And you have to, when you're looking at the industrial metals, you have to say, what's really going to happen in terms of industrial demand for these metals? And you mentioned the incoming new government. There's total uncertainty as to what they're going to do, what they're going to try to do, and what they'll succeed in doing. And there's a lot of uncertainty about what all of the other actors in the U.S. economy and the global stage will be doing too. So there's probably greater economic and political uncertainty today than there was at any given point since World War II. And you could even say since 1941 when the U.S. entered World War II, because once the U.S. entered World War II, I think a lot of uncertainty went away. It was just a matter of timing. But I think there's this tremendous uncertainty, and that is going to limit business investment and industrial activity, with the risk of a recession at some point in 2025 or 2026 that will hang over investment decisions. So I think that industrial commodities are less attractive to us right now, and gold and silver as, quasi money, as financial assets. I think gold and silver are the two metals that we're really interested in.
And just finally, annually, you put out reports on gold and silver. Do you have any reports that are coming up that people should know about?
Well, we'll come out with our gold yearbook in March and our silver yearbook in May and our platinum group metals yearbook in July. Those are the big books that we do, 200, 300 pages on each metal. But then we do other things too. So, for example, right now, Rohit Savant, who's our lead research analyst, is working on a report on gold, which we will produce for one of our clients. And that client will make that report available, and it will sometimes tell CPM Group that we can offer that report to other people. We'll have that report on gold, and then we'll have reports for that client in silver and platinum group metals over the next couple of weeks. And then in early March, during the PDAC, we'll come out with a brief, like a 30-page report on silver, supply, demand, price outlook for silver, which we have been doing every year for the last 21 years with the PDAC.
Jeffrey Christian, Managing Partner of CPM Group, thank you for joining us and sharing your wisdom with us here on this week's Northern Miner podcast.
Adrian, it's always a pleasure to talk to you.
Thank you once again to Jeffrey Christian for appearing on this week's podcast. And thank you, dear listener, for continuing to tune in and support the program. Really appreciated the people coming up to me and saying hi after presenting at the Vancouver Resource Investment Conference. It meant a lot. And it was just really great to meet some of the people who are listening. So big shout out to those people, and a shout out to everybody out there listening around the world. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.